The US dollar weakens again overnight to near its low for this year. Australia's inflation figures today will be dominated by government subsidies, lowering electricity prices, and there's welcome news for the Bank of Japan in producer price inflation figures. That's coming up in our 5 Things in 5 minutes. And then in our bonus deep dive interview, ANZ's agriculture economist, Susan Kilsby, explains what's behind the rise in dairy prices, which have led ANZ Research to boost its New Zealand farmgate price forecast.
Produce about 1.9 billion kgs of milk solids in New Zealand, so another dollar on that basically returns another $1.9 billion into the farmers' pockets.
But first, in 5 and 5 with ANZ, the US dollar index has weakened about 0.2% overnight to near its lowest level this year, while US stocks firmed because US consumer confidence rose slightly to a 6-month high of 103.3 in August. The measure is still down from 111 at the start of the year, indicating a more cautious attitude to spending, according to ANZ Head of G3 Economics Brian Martin. Meanwhile, attention's turning to the European Central Bank and what it will do with rates ahead of the US Federal Reserve on September 12th. One governing member overnight said the path was clear, while another said more information was needed to cut. Here's Brian.
I think we're going to have to see what the money supply data are at in the next coming days, what the upcoming inflation numbers will be too. But I do think the direction of travel is very clear for Europe. Rates need to come down, and our view is that they will be cutting interest rates 25 basis points when they next meet.
With that weaker US dollar, the Aussie is trading up 0.24% at 67.87 US cents at 4 a.m. Sydney-Melbourne time, while the Kiwi was up 0.68% at 62.46 US cents. Number 2. In Australia today, the July partial CPI indicator is expected to show a fall in the annual inflation rate to 3.3% from 3.8% in June, as the effect of electricity rebates flows through. But as ANZ senior economist Catherine Birch explains, the effect of these temporary rebates will mean headline CPI isn't going to be a good reflection of the underlying state of play over the next year or so.
We're expecting that the electricity rebates alone, as part of federal and state government's cost of living relief measures, those electricity rebates will take about 0.6 percentage points off headline inflation in the second half of this year. And so that will mean that headline inflation is going to fall to within the RBA's 2 to 3% target band pretty soon. But that doesn't mean the job is done because it's temporary. And we expect that headline inflation is going to jump back above 3% in the second half of next year when those rebates have waned. So we really need to focus on underlying measures like the trimmed mean measure of inflation.
Number 3. The ANZ Roy Morgan Australian Consumer Confidence Survey showed little change in the past week. It eased 0.4 points. The major mover was a 2.6-point jump in the time to buy a major household item sub-index after a 6-point fall last week. ANZ economist Maddie Dunk says there were also positive signs from the survey's inflation expectations measure.
We had seen in the prior week that inflation expectations had fallen to a 2.5-year low at 4.7%. And most of that momentum was maintained. So inflation expectations lifted slightly to 4.8%, but I think broadly the RBA would be happy with what they're seeing on that inflation expectations front, and we are seeing some progress down towards a more sustainable lower level for inflation expectations.
Maddie says another interesting feature was confidence among renters continued to rise. It's now higher than those paying off a home loan.
We did see in the federal budget and also the state and territory budgets that there were a range of cost of living measures announced. A lot of those were targeted towards people who were on lower incomes. We know that there was the increase in the Commonwealth rent assistance as well. So those things might be helping households who are renting at the moment. And I think broadly too, it does seem like we have passed the peak in rental growth. Now rents are still growing very highly. Anyone who is a renter can attest to that, just given how tight the rental market is right now. But it does appear like we're past the peak.
Number 5. Producer price inflation in Japan rose 2.8% in the year to July. It was slightly below expectations and below the previous month. ANZ FX analyst Felix Ryan says despite the slight drop, the rate of growth in the PPI remains historically high.
June's 3.1% gain was actually the largest year-over-year figure since September of 1991 if you exclude some of the impacts of sales tax hikes. So it does confirm that the services-led domestic-driven inflationary pressures are starting to build. It does support the case Bank of Japan. Policy normalisation in the rest of the year and going forward, we should see, I suppose, services PPI continue the upward trend, especially as some of the wage increases flow through the economy. So it's definitely a data point to keep an eye on going forward from here.
Felix Ryan there. Now, in our bonus deep dive interview, ANZ agricultural economist Susan Kilsby has increased her forecast farmgate milk price for the new 2024-25 year. Here she's talking to my colleague Alex Tarrant about what's driving the lift and what it means for dairy farmers.
We're now forecasting a milk price of $9 per kg of milk solids for the 2024-25 season. That was just started. So prior to this, we were forecasting $8.50. So this is a 50-cent increase in that. And it's certainly considerably higher than what we were expecting will be paid for the previous season. So for the 23-24 season, we're expecting that'll come in at about $7.85. So $9 is a pretty high payout in historic terms. So we've had a payout higher than that once before. We had a $9.30 payout a few seasons back, but it would be one of the highest payouts that we have seen.
And what's the reason behind the increase for the payout? I see the global dairy trade prices have been on the rise recently. Why is that?
Yeah, so the dairy commodity prices are trending up. They've been relatively low for a while. I mean, what's really driving that is the fact that global milk supply is relatively subdued. It's growing a little bit, but certainly not at a fast pace like we've seen previously. So it's reasonably subdued, and demand just seems to be sufficient at the moment to absorb the milk that is available. And it's particularly pleasing to see these early season auction prices rising, because we do have a lot of dairy product to sell at this time of the year as we're starting to sell new season's product. To see the strength in the pricing at this time of the year is really positive and indicate we should have a good season ahead. That said, it is still early in the season and things can change, but we're reasonably optimistic that we're trending in the right direction.
What is causing that subdued global supply?
So dairy farmers around the world just haven't been making massive profits anywhere. So there just really hasn't been the incentive to expand. Some regions are also reasonably constrained by environmental constraints. So several of the European countries can't really expand their dairy any longer because they're meeting limits in terms of nutrient discharge. So that's one factor limiting it. But generally, it's just the fact that the profitability in dairy hasn't been really high in recent years. And if we look at dairy commodity prices at the moment, they're trending up, but they're still not really high in historic terms. But what is helping New Zealand farmers at the moment is that the New Zealand dollar is still relatively low. It's come up a little bit, but it's still pretty low. So the returns back in New Zealand dollar terms are considerably greater than what they'd be if we had a stronger dollar.
You put something in your note about input costs that New Zealand farmers are experiencing. What's happening there, or what's going to happen, do you think, next year compared to the year we've just had?
Yeah, so input costs, I mean, we've had a period that we had very strong inflation in input costs, and a lot of the costs got really high. Over the past 12 months or so, we've seen farmers pulling back on spending where they can. So this last season, they're kind of sitting around a break-even level, and they've definitely pulled back on any discretionary expenditure. So that's the likes of feed and fertiliser and repairs and maintenance. So looking into next season, we expect to see some of those costs come up a little bit more as there's a bit of catch-up in terms of repairs and maintenance and fertiliser going on to the farms. But we do expect that there will be a profit margin next or the current season that we're just coming into, whereas last season there was very little profit.
And so the 50% increase in the forecast milk price, and I guess the difference, about $1 between last year and the new season, what does that mean sort of at the farm level in terms of the amount of money going into farmers' pockets?
Yeah, so I mean, we produce about 1.9 billion kgs of milk solids in New Zealand, so another $1 on that basically returns another $1.9 billion into the farmers' pockets, which they'll then spend, and that'll have a multiplier effect through the economy.
Susan Kilsby there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, August the 28th. Catch you tomorrow with analysis of that Australian inflation data. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.